Good evening, everyone. Time for another silver update. Now, this is the 1-minute gold chart provided by netdania.com. You can see here that at the opening of this big day where the Fed was going to end quantitative easing, at least that's what everybody expected, and that's what they ended up doing. You can see here, right at the opening here, this is a New York opening, we've got a big smackdown in gold. Let's pull up the volume. So this is a pattern that we've seen a lot. Any day where the Fed is going to do anything, release minutes, have a meeting, make an announcement, they always make sure that they smash the precious metals on the open. And then, of course, then they smash them even more when they make the announcement. It doesn't matter what the announcement is. It doesn't matter whether it's bullish for stocks or bearish for stocks, bullish for gold, bearish for gold, bullish for the dollar, bearish for the dollar. It doesn't matter. They always do the same thing, and that is they attack the paper price of gold and silver when they make the announcement and when that day begins. So you can see here the sell-off in gold, fairly dramatic once the announcement that QE is over. This, as Peter Schiff has pointed out, has happened in the past where they've announced that QE is over and then they announce another round of QE. So by no means does that mean that there isn't going to be more. It just means that the current round is over. So the drop is 1226 roughly down to about 1209. So not a lot of damage when you look that we spiked back up to about 1216. We're back to about 1214. You can see we're climbing fairly rapidly. Now, the damage in silver wasn't nearly as bad. It's almost kind of like silver has just been beaten so badly that there's hardly any downside left anymore. At least that's what it kind of seems like. So not a lot of activity in silver. You can see now in the after hours it's taking a quick spike up. So you can see in the currencies, this is the euro, big drop on the Fed's announcement. The Japanese yen, big drop in the value of the yen versus the dollar, about a point. So that's typical, that's par for the course. So what is this announcement and what does it mean? The announcement is that they're ending the current round of quantitative easing. Well, I'm going to go into some stories about quantitative easing, but before I do that, I want to play just one video here, and this is one I posted at the top of the blog. This is a video that was made 4 years ago, and this is a video, the bears talking about quantitative easing and trying to understand why they're doing it. And we're going to look and see what the results have been. But let's take a time machine and go back 4 years ago and listen to the bears talk about quantitative easing and ask yourself, are the things they're saying true today as they were back then?
So why do they want to print the money?
Because they say we have the deflation, and the deflation is very bad.
What is the deflation?
The deflation is when prices of the things we buy go down.
Isn't that good? Doesn't it mean the people can buy more of the stuff?
Yes, but the Fed said this is bad, especially during the recession.
So they think that during the recession, when the people have less money to buy the stuff, it is bad that the prices go down?
Yes, the Fed would rather have the inflation.
So why does the Fed think we have the deflation?
Because the CPI said so.
But aren't the food prices higher than a year ago?
Yes.
Aren't the gas prices higher than a year ago?
Yes.
Aren't the healthcare costs higher than a year ago?
Yes.
Aren't tuition prices higher than a year ago?
Yes.
Aren't the taxes higher than a year ago?
Yes.
Aren't the subway fares higher than a year ago?
Yes.
Aren't the stock prices higher than a year ago?
Yes.
Aren't the bond prices higher than a year ago?
Yes.
So what is deflating right now?
The only thing deflating that I can see is the Fed's credibility.
Did they have a lot of credibility to start with?
No.
Why not?
Because the Fed has been wrong about every major economic development in the past 20 years.
You mean they didn't see the internet stock bubble?
No. In fact, they helped fuel the internet stock bubble.
And they didn't see the housing bubble?
No, in fact, they helped cause the housing bubble.
And they didn't see the subprime crisis?
No, in fact, they told us subprime problems were contained right before the stuff hit the fan and the Lehman went bankrupt.
So has the Fed ever been right about anything?
Let me see if I can think of anything. No, nothing.
There you go. So the Fed's credibility is absolutely zero. Now, what you can see from what the bear is discussing there, everybody knows that at that time, all those prices had gone up from a year ago. And we know today, all of those prices have gone up from a year ago. So what is the effect of quantitative easing? Well, one of the effects of quantitative easing is here. This is from Zero Hedge. These are the cash balances at banks versus total Federal Reserve balances. And you can see back in the beginning of 2008 where we were at. This lower blue area here are the small domestic banks, so just your mom and pop banks. The red is the big banks, the JP Morgans and the Goldman Sachs of the world. And the yellow here are foreign banks. So you can see that the foreign banks didn't have any balances from the Federal Reserve, and now they're the largest beneficiaries of QE3. So how does that make you feel to know that the Federal Reserve has taken about $1.6 trillion and given it to foreign banks? Now we have Alan Greenspan coming out and admitting that QE was a failure. It failed to help the economy. Well, who did it help? Well, it helped the banks. It helped the foreign banks. It helped the rich people who own stocks, because that's where the banks put all the money, in the stock market. Mr. Greenspan's comments to the Council on Foreign Relations came as Fed officials were meeting in Washington, D.C. and expected to announce within hours an end to the bond purchases. He said the bond buying program was ultimately a mixed bag. He said that the purchases of treasuries and mortgage-backed securities helped lift asset prices and lower borrowing costs, but it didn't do much for the real economy. Quote, effective demand is dead in the water, and the effort to boost it via bond buying has not worked, said Mr. Greenspan. Boosting asset prices, however, has been a terrific success. And then we get the advice from Mr. Greenspan about gold. Mr. Greenspan said, gold is a good place to put money these days given its value as a currency outside of the policies conducted by governments. So here's your original bubble blower now, backing out and admitting that these policies are a complete failure. Actually, they weren't a complete failure. They were a tremendous success if the goal of these policies was to destroy the middle class, to enrich the criminal banksters on Wall Street, and to enrich their criminal bankster friends in Europe. That's exactly what happened. So let's look at this other article from Zero Hedge. This is talking about the result of QE and the hinting at the ending of QE. This is a very interesting chart. Now, I've shown you before we get to this, let me take you over to the chart that I've been showing you a lot of, and that is the Dow Jones Industrial Average. And as I was pointing out in my VIX Fix video, that this type of movement here is an indication of tremendous volatility in the stock market. You can see a high of 17,348 on the Dow, and that is in late September, down to a low of 15,855. So that's a move of almost 2,000 points, 1,800 points, and then back again. Now, if that isn't volatility, I don't know what is. But let's go back to that article by Mark St. Cyr talking about the ridiculousness of this activity that happened based on these comments by this Bullard character. And if you remember, Bullard was the one who said we need to remove some accommodation and then reversed himself. So let's read this. So let's put a little perspective on this whole thing we now know as QE and shed some light on the brilliance and the understanding of monetary policy that many of these so-called financial show hosts state they know so much about. First, What great economic reason would they give that stopped the Dow 30K narrative in its tracks to then watch it plummet, wiping out all of the gains of 2014, to then reverse and edge back towards the never before seen in the history of mankind highs? There was only one: Federal Reserve, Bank of St. Louis, and this is non-voting President James Bullard, period. All one has to do is look at the chart for proof. And here's the chart. There's Bullard's first comment. Then Bullard blinked and made this comment: a logical policy response at this juncture is to delay the end of QE. And I think he actually mentioned QE4. And then here we are today with the end of QE. So what does this mean? What are these markets? Well, these markets are completely fake. I want to take you to a video that is Ann Barnhart video, very good video if you don't understand derivatives. It's a simple breakdown for novices to try to understand what this is. But she's just given us the figure of derivatives worldwide, and the number was 1.5 quadrillion. And then she's going to talk about how this is computers doing all of this.
These amounts of money don't even exist. We're into the domain of things that aren't even real anymore. Globally, derivatives exposure is at minimum $1.5 quadrillion. I told you we'd be talking about quadrillions. Okay, what we've been talking about is just the United States. What about Europe? What about China? What about Japan? What about them? Okay, now we're into the quadrillions. Where's your wealth? Remember the list of people that we just went through? Banks, insurance companies, pension funds, on and on and on. This is where your money is. Money market funds, state and local governments. This is where your money is sitting. You need to get out. Because when the system collapses, it will happen so fast, you won't have time to react. You've got to get out. When should you be exiting the system? The answer is now. Computer programs, high frequency trading, HFT, you'll see that, that acronym, also called the algos, which is short for the algorithms. Just computers, completely independently, computer programs trading the markets. Guys, that's all that's left. Computer programs now account for 70% of all completed transactions in the equities and futures markets, and 99.9% of all quotes in the equities and futures markets. The people are gone. The smart people started leaving years ago. There's nobody left. So you look at the volume on the exchanges for stocks and futures and so forth, and well, look at all this volume. Look at how many contracts they traded today, and look how many shares they traded today. It's not real. It's computers trading with each other, in and out in milliseconds. There's no people in there anymore. This is incredibly dangerous. And this, these statistics come from Nanex. It's just an analytical company that does great work parsing all of this high-frequency trading data and information. Market liquidity is totally dependent upon the algorithms now. As you could see, I mean, 70% of all completed transactions and 99.9% of all bids and asks are computer generated. Well, of course the markets are completely dependent upon them. These algos are programmed to stop trading in the event of a black swan market shock. If anything crazy happens, the computers are programmed to step back. What does that mean? That means if anything crazy happens and the algos stop generating bids and offers, since there are no people left in there, the markets are going to go no bid like that. And then good luck getting out of your positions. Oh, it's no problem. I'll call my broker and he'll just put the orders in. What if there's nobody on the other side? You want to sell your shares. There's no bid. There is no bid. What are you going to do?
Now, if you think she's exaggerating on that, she really isn't. If you remember the May flash crash, there were stocks in the stock market that literally went no bid. And the prices of some of these stocks actually went down to a penny from prices of $50 to $100 a share, and they went down to a penny and then came back, of course, probably when they fired up the algos again. So she's absolutely right. This is a completely fake market. In fact, all of these markets are now fake markets. They are markets where the computers that are controlled by the government, essentially, the big banks and the government, and they're in bed with each other, they're the only ones trading. So you can see the volatility. The computers came in and bought and sold and bought and sold and bought and sold, but basically they ended it flat in the stock market. Right there at 2, that's about where we ended. So is this going to roll over and continue down? Well, again, it's computers that completely control it. So the only question is are they going to pull the plug? Now, the big issue for all of us is, where are we going to be when they pull the plug? Because at some point they're going to pull the plug and it's going to be game over. And what percentage of your assets are in the systems that they control? Now, Ann Barnhart went through and gave a very good explanation of how these derivatives work, especially the reverse repos and the repos and the CDOs and CDSs and all these things, and why they're doing them. And I can guarantee you they're still doing them. And here's the reason why. This is the reason she gave. We are still, even though the Fed has told us that they've stopped QE, at least this round of QE, they still have maintained ZIRP. In fact, they gave the language today that the foreseeable future quote. So they've extended it out into the future. No one knows what that means for sure. That may mean 1 year, 2 years, that they're going to leave interest rates at 0. Now, if interest rates are at 0, how are the insurance companies, the hedge funds, the pension funds, the retirement funds, all of these investors, how are they making money? They're making money through derivatives and risky bets. So all of these investments, no matter how safe you think they are, and that even goes for money markets, because there's a lot of money markets that are paying 1, 2 something percent. Well, how are they making that money? Because interest rates are at 0.5 or 0.2. Well, they're playing the derivatives market. So everybody's playing the derivatives markets, and these computers are playing with each other, and there's no question that the whole thing is just going to go belly up all at once. And when it does, they're just going to shut it down. It's going to go no bid. So we're watching gold really closely. We've got some activity in the after hours here that seems to indicate that we may get a rally. They tried to bring it up here, and now it looks like they're trying to bring it up again. It wouldn't surprise me at all to see, we've seen this before, where the Fed gives some announcement, it has a big reaction, and then it kind of comes all the way back to where it was before the announcement, and it just kind of goes away and is unimportant. And that appears to be already happening in silver, which is kind of interesting to see silver being stronger than gold. Normally silver is always weaker than gold, but you can see that silver is back to actually above everything but the first sell-off that started with the Fed's announcement. So that's what we're going to be watching going forward. But again, we're looking for stacking opportunities if we go into new lows. The coins that I've been watching are still not really available from the sellers that they were available. Congratulations to everybody that snapped them up. We could get a drop down lower. Certainly if we pull out on the gold chart, it appears to be rolling over. If we go out to the daily, you can see there's kind of this rolling over activity. How does that fit into the trend lines? Well, it kind of matches up to where we came up to. It failed before it got there. This is going to be the trend line we're testing. Silver, on the other hand, is quite a bit stronger, but in terms of the trend line, we'll go to the biggest one here. You can see we're significantly below it. So there's quite a ways to run before we even violate this major trend. So there's still a lot of stacking opportunities, but you have to remember that, as Ann Barnhart pointed out, these paper markets can go no bid in an instant. And then once they do, it's game over. And we'll talk to you next time.